Have you ever placed a trade that looked perfect, only to watch it hit your stop loss, and then immediately move in the direction you originally predicted? Or maybe you've held on to a winning trade for too long, hoping to make even more profit, only to watch the market reverse and wipe out your gains. If that sounds familiar, you're not alone. One of the biggest differences between profitable traders and struggling traders isn't finding the perfect entry. It's knowing where to exit. In today's video, I'll show you how to place your stop loss and take profit correctly so you can protect your trading account, manage risk effectively, and become a more disciplined Forex trader. By the end of this lesson, you'll understand how professional traders decide where to exit a trade and why guessing your stop loss is one of the fastest ways to lose money. Let's get started. Welcome to Build Smart AFRI, where we simplify Forex trading, AI, technology, and online business for beginners. If you're serious about improving your trading skills, make sure you subscribe and turn on the notification bell so you never miss our weekly educational videos. Now, let's dive into today's lesson. What is a stop loss? Let's start with the most important tool in risk management. A stop loss is an order that automatically closes your trade if the market moves against you by a certain amount. Think of it as your safety net. No trader, not even the best in the world, wins every trade. Losses are a normal part of trading. The goal isn't to avoid losing altogether. The goal is to make sure one losing trade doesn't destroy your entire trading account. Imagine you're driving a car. Even if you're an excellent driver, you still wear a seatbelt. Not because you expect to crash, but because you want protection if something unexpected happens. A stop loss works exactly the same way. It protects your trading capital when the market doesn't do what you expected. Without a stop loss, one emotional decision can wipe out weeks or even months of hard-earned profits. Why every trader needs a stop loss. Many beginners believe they can simply watch the market and close the trade manually if it starts going against them. That sounds easy, until emotions get involved. Imagine you've bought EUR/USD. The market starts falling. Instead of accepting a small loss, you tell yourself, it'll come back. The price falls even further. Now you're thinking, I'll wait just a little longer. Minutes become hours. Hours become days. Before you know it, what started as a small loss has become a huge one. This happens every single day to traders around the world. Professional traders avoid this trap by deciding their maximum acceptable loss before they even enter the trade. Once the stop loss is placed, the decision has already been made. No emotions, no panic, no second guessing. That's one of the biggest reasons successful traders survive in the market for years. What is take profit? Now let's talk about the other side of the trade. A take profit is an order that automatically closes your trade once your profit target has been reached. Think of it as your exit plan. Many beginners know where they want to enter a trade, but they have absolutely no idea when they should leave. They simply watch the market move in their favor and think, maybe it'll keep going. Sometimes it does. Sometimes it doesn't. The market suddenly reverses. Their profit disappears. And in some cases, a winning trade actually turns into a losing trade. Professional traders don't allow that to happen. Before entering the market, they already know where they'll buy or sell, where they'll admit they're wrong, and where they'll take their profit. Everything is planned in advance. That's called disciplined trading. Why take profit is just as important as stop loss. Imagine you buy GBP/USD. Within an hour, your trade is up 80 pips. You're excited. You think, maybe I can make 150 pips instead, so you don't close the trade. Then news is released. The market reverses sharply. Instead of making 80 pips, you close the trade with only 10 pips. Or even worse, you end up losing money. Greed is one of the biggest enemies in Forex trading. A take profit helps remove that emotion. Instead of chasing every last pip, you follow your trading plan. Consistency beats greed every single time. The biggest mistake beginners make. Here's the mistake I see most often. A beginner opens a trade, then randomly places a stop loss that's only 10 pips away. Why? Because they don't want to lose much money. A few minutes later, normal market movement hits their stop loss. The trade closes. Then the market moves exactly in the direction they originally predicted. They blame the broker. They blame market manipulation. But the real problem wasn't the market. It was poor stop-loss placement. A stop-loss should never be based on fear. It should be based on market structure. That's exactly what we'll learn next. Where should you place your stop-loss? Now comes the most important question. You know you need a stop-loss. But where exactly should you place it? This is where many beginners make costly mistakes. Some traders simply choose a random number. Maybe 10 pips, maybe 20 pips, maybe 50 pips. But the market doesn't care about random numbers. The market moves according to price action. That's why professional traders place their stop-loss based on what the chart is telling them, not on emotion. Let's look at the best methods. Method 1. Place your stop-loss beyond support or resistance. One of the most common ways professionals place a stop-loss is by using support and resistance. Imagine you're planning a buy trade. Price has pulled back to a strong support level. A bullish candlestick pattern appears. Everything suggests buyers may take control. Where should your stop-loss go? Not directly on the support level. Instead, place it slightly below the support zone. Why? Because the market often moves a little below support before reversing upward. This is called a false breakout or fake out. If your stop loss is too close, you'll get stopped out even though your trade idea was correct. Now let's look at a sell trade. Suppose price reaches a strong resistance level. A bearish engulfing candle forms. You're expecting the market to fall. Your stop loss shouldn't sit exactly on the resistance line. Instead, place it slightly above the resistance zone. This gives the market enough room to move naturally without stopping you out too early. Remember this, your stop loss should be placed where your trading idea becomes invalid, not where you're simply uncomfortable losing money. Method 2. Use swing highs and swing lows. Another technique professionals use is the market structure itself. Every chart creates highs and lows. If you're buying, look for the most recent swing low. If price breaks below that swing low, buyers have probably lost control. That's usually a good place for your stop loss. If you're selling, look for the most recent swing high. If price breaks above it, sellers may no longer be in control. Again, your stop loss is based on what the market is doing, not on random numbers. Method 3. Use the average true range, ATR. Some experienced traders use an indicator called the average true range, or ATR. Don't worry, it's not as complicated as it sounds. The ATR simply measures how much a currency pair normally moves over a certain period. Imagine EUR/USD usually moves about 40 pips during the trading session. Would placing a stop loss just 10 pips away make sense? Probably not. Normal market movement could stop you out before the real move even begins. The ATR helps traders avoid placing stops that are too tight. Instead, they give the market enough room to move naturally. Where should you place your take profit? Now let's talk about taking profits. Many beginners only think about making money. They never think about where they'll actually exit. That's a mistake. Every trade should have an exit plan before you click the buy or sell button. Let's look at the best methods. Method 1. Target the next support or resistance level. This is probably the easiest and most effective method. Imagine you've bought EUR/USD from a strong support zone. Ask yourself this question. Where is price most likely to struggle next? Usually, the answer is the next resistance level. That becomes a logical place to take profit. The same idea works for sell trades. If you're selling from resistance, the next support level often becomes your profit target. You're allowing the market structure to guide your exit. Method 2. use a risk-to-reward ratio. Professional traders don't enter trades hoping for random profits. They calculate risk first. Let's say you're risking 20 pips. Would risking 20 pips just to make 10 pips be worth it? Probably not. Many successful traders look for a minimum risk-to-reward ratio of 1:2. That means if you're risking 20 pips, your profit target should be around 40 pips. Some traders even look for 1-3 trades. So if the risk is 30 pips, the reward becomes 90 pips. This is powerful because you don't have to win every trade to become profitable. Imagine taking 10 trades. You win 6. You lose 4. If every winning trade makes twice as much as every losing trade, you're still growing your account over time. That's how professional traders think. They focus on probability, not perfection. Real Forex example. Let's bring everything together. Imagine you're looking at EU/USD. The market has been trending upward. Price pulls back to a strong support level around 1.1 thousand. A bullish engulfing candle appears. This confirms buyers may be returning. You decide to buy. Entry 1.1710. The recent swing low sits at 1.0985. Instead of placing your stop loss exactly at 1.1 thousand, you place it slightly below the swing low at 1.980. Now your trade has enough breathing room. Next, you look at the chart. The next major resistance sits around 1.1170. That becomes your take profit. Notice something important. Every decision came from the chart. Not emotions, not guessing, not hope. Everything followed a logical trading plan. How to set stop loss and take profit correctly in Forex. 7 common stop loss and take profit mistakes beginners make. Now that you know where to place your stop loss and take profit, let's talk about something equally important. Even with the best trading strategy, small mistakes can cost you money. Here are the 7 biggest mistakes beginners make, and how you can avoid them. Mistake number 1. Trading without a stop loss. This is probably the biggest mistake of all. Some beginners believe they don't need a stop loss because they'll close the trade manually if it goes against them. But markets can move extremely fast, especially during major news events. Imagine you're away from your computer for just 5 minutes. Unexpected news is released. The market moves 100 pips against your position. Without a stop loss, your account could suffer a much larger loss than you planned. Remember this, every professional trader uses a stop loss. If professionals protect themselves, you should too. Mistake number 2. Moving your stop loss further away. Let's say your stop loss is about to be hit. Instead of accepting the loss, you move it another 20 pips lower. The market keeps falling, so you move it again. Eventually, what started as a small planned loss becomes a huge one. This isn't trading, it's hoping. Successful traders accept that losses are part of the business. Once your stop loss is set, don't move it simply because you don't want to lose. Mistake number 3. Taking profit too early. Imagine your trade is already making money. You see 15 pips in profit. Fear kicks in. You quickly close the trade. A few hours later, the market moves another 80 pips in the same direction. Sound familiar? Many beginners are comfortable taking tiny profits, but uncomfortable accepting small losses. Professional traders do the opposite. They allow winning trades enough room to reach their planned target. Mistake number 4. Ignoring the risk-to-reward ratio. Before entering any trade, ask yourself one simple question. Is the potential reward worth the risk? If you're risking 50 pips to make only 10 pips, even a high win rate may not make you profitable. Instead, look for trades where the reward is at least twice the risk whenever possible. That's how many successful traders stay profitable over hundreds of trades. Mistake number 5. Using the same stop loss on every trade. Some traders always use 20 pips, 30 pips, 50 pips, regardless of the market. But every currency pair behaves differently. EUR/USD doesn't move the same way as GBP/JPY. The market is always changing. Your stop loss should adapt to the chart, not the other way around. Mistake number 6. Letting emotions control your decisions. Fear, greed, hope, revenge. These emotions have destroyed more trading accounts than bad strategies ever have. A good trading plan removes emotions. Before entering a trade, decide your entry, your stop loss, your take profit. Then allow the market to do its work. Discipline is often more valuable than having the perfect strategy. Mistake number 7. Risking too much on one trade. Here's a simple question. If one trade goes wrong, will your account survive? Professional traders rarely risk a large portion of their capital on a single trade. Many choose to risk only a small percentage of their account on each position. This allows them to survive losing streaks and continue trading another day. Remember, the goal isn't to get rich from one trade. The goal is to stay in the market long enough to become consistently profitable. Professional tips for better risk management. Before we finish, here are a few habits used by disciplined traders. Always calculate your risk before entering a trade. Let the chart determine your stop loss, not your emotions. Never move your stop loss further away because you're hoping the market will reverse. Use a take profit based on market structure or a favorable risk-to-reward ratio. Keep a trading journal and review every trade. The more you review your decisions, the faster you'll improve. Key takeaways. Let's quickly recap today's lesson. A stop loss protects your trading account when the market moves against you. A take profit locks in your profits before emotions take over. Professional traders don't guess where to place these orders. They use support and resistance, swing highs and swing lows, market structure, risk-to-reward ratios. Most importantly, every trade is planned before entering the market. That's one of the biggest differences between gambling and professional trading. No trading strategy can guarantee 100% winning trades. Losses are part of Forex trading. What separates successful traders isn't avoiding losses. It's managing them wisely. If you learn how to control your risk, stay disciplined, and follow a consistent trading plan, you'll give yourself a much better chance of becoming profitable over the long term. Remember, protect your capital first. Profits come later. If you found this lesson helpful, please give this video a thumbs up and subscribe to Build Smart Afri for more beginner-friendly Forex trading tutorials. Turn on the notification bell so you never miss our weekly videos covering Forex, technical analysis, risk management, AI, technology, and online business. I'd also love to hear from you. What's your biggest challenge when setting stop loss or take profit? Leave your answer in the comments below, and I may cover it in a future video. For more in-depth Forex guides and free learning resources, visit buildsmartafri.com. Thanks for watching. Stay disciplined, protect your capital, keep learning, and I'll see you in the next video. Happy trading!